Good morning, and this is the lecture to accompany week 10 in ITS836. Um, Bitcoin specifically. Last week we talked about blockchain, but the only reason anybody knows anything about blockchain is because of Bitcoin. So here we go. There's another um, uh, PowerPoint, but this will suffice for the research paper that's due this week, which is to just talk about a couple of companies that have accepted it and accept Bitcoin, and one that does not. So we will get started. So as we know, uh, Bitcoin started out as a paper by an unidentified author, Satoshi Nakamoto, back in '08, and it was implemented as the Bitcoin um, network in '09. So yeah, it's open source software. So there is absolutely nothing to keep people from creating an alternate chain, an alternate blockchain based on the same software that Bitcoin uses. So yeah, public ledger. So every transaction is transparent to the network, which kind of flies in the face of anonymity. I think we'll talk about that a little more this morning. Um, Now, I'm not the author of these slides. These are from the university, so I will speak to them. And as I find something that's confusing to me, I will discuss it. If you are also confused and you want to discuss it, shoot me an email, and we can definitely go through it together. Um, we're saying it's a form of currency. I say that it's not really a form of currency because it's not issued by a government. But it is, yeah, it's a digital token, a digital thing, and it can be used to buy things electronically. Kind of um, try and use a native Bitcoin uh, on Amazon or someplace and see what happens. Let me know how that goes. Um, and it's commonly referred to as a cryptocurrency. And since there are only 20 million bitcoins that can ever be mined, ever be put into production, so naturally there's got to be a subunit, like cents are to dollars or pennies are to dollars. So we've got this thing called a satoshi. That's a 100 millionth of a bitcoin. So each satoshi is still worth what, a dollar or two, right? No, I'm kidding. Bitcoin's back down to 35,000 or so. Very volatile. Anyway, what is it based on? Wild speculation. It's based on that protocol, that open source um, implementation of cryptography. That's really what we're talking about here. Cryptography, um, which has been around a long time, but there we go. And it's based on that cryptography and the wager, the perception, the bet that it's unhackable and it's going to be maintained. It's going to be secure, but it's not based on a fixed quantity of metal, um, which is a resource currency, or I'm sorry, a commodity currency. So that there's intrinsic value in the coin itself. If you make, if you trade in gold coins, Krugerrand say, there's value in the coin itself. It's 997% gold, pure gold. So yeah, Bitcoin's none of that. But a fiat currency is what the United States dollar is. It's what virtually every currency on the planet is. It's kind of like Bitcoin. It's in that it is its value is held by the perception of its owners. Okay, but Bitcoin is not like a fiat currency, the U.S. dollar, because it is decentralized. No one owns or regulates or steers or anything with the Bitcoin network. It's uh, yeah, uh, decentralized. Um, it's easy to set up and it is fast, which maybe in 2008 it was fast. Takes 10 minutes now on average to the best of my reading, to confirm a Bitcoin transaction. I don't know how you consider that fast. Go to the ATM and cash out a Bitcoin and wait and stand there and wait 10 minutes and tell me it's fast. Oh, and full disclosure, I'm not a Bitcoin or blockchain uh, adherent or believer or um, I don't think there's anything cosmic about it. I don't think there's anything new or innovative, and I think I believe all the downsides, and I don't adhere to any of the upsides. So that's just me. Um, uh, but I could certainly be wrong. Uh, so anyway, just full disclosure, so you know. Yeah, it's anonymous, but yet it's transparent. I don't get it. Um, if those two words in this context are oxymorons. You can't have both. It either isn't transparent or it isn't anonymous. Um, so anyway, yeah, shoot me an email if y'all are in the blockchain major and you get sick of older people like me dogging on blockchain, dogging on. Shoot me an email. Let's talk it over. Transaction fees are minuscule. Transactions are irreversible. So yeah, this is a lot of these slides were taken from basically taken from the web, and so it's going to have one position or the other. We'll see. Decentralized, um, because nobody owns the Bitcoin database. There are multiple copies that everybody chunks on to agree that a transaction occurred, and all of the copies are updated before a transaction is finalized. So, yeah, in theory, I guess there's an algorithm that sets the value based on people trying to buy it. I like I said, I look forward to reading your papers. Perhaps you can explain things differently than your predecessors, because I still don't get it. So we'll see. Okay, animosity and transparency. So what that is probably anonymity. I don't, yeah, animosity is what I feel for Bitcoin. And this slide doesn't talk about animosity. Um, Animosity is a dislike for something or an aggression, a disapproving opinion of something. Uh, all right, so here's to animosity. So bitcoins are stored in a wallet, and that's the public key, private key. Which the public key is like an account number. The private key is your password. And there was a story not terribly long ago where a guy forgot his password. He's sitting on a couple $1 million worth of bitcoins and couldn't remember his private key. So there you go. That's just one little tiny risk. Or if somebody dies and it's not written down anywhere, and that what happens to that Bitcoin? What happens to the Bitcoin in that wallet? Yeah. Anyway, so yeah, the transaction is when the public and private key are exchanged, and the transaction shows the new owner. Um, which see, I don't understand why this is so great for hacking. If it's so transparent that you should be able to follow where the money went, and once it gets into the traditional financial system and starts hopping around banks, it's traceable. So yeah, I don't know. We'll see, guys. Um, Stores the details of every transaction except who did the transaction. Because if it said who, it wouldn't be anonymous, right? So yeah, there you go. Negligible fees. It doesn't charge any yet. The cost of this um, mining, which is really just guessing um, the blockchain and confirming um, the transaction. Um, you get bitcoins for supporting the network, for becoming part of the processing network. Um, so uh, yeah, so there's no fees. But once we hit 20 million bitcoins, which it gets exponentially harder and harder and harder and harder the longer the chain becomes, the longer the blockchain becomes, the longer the transactions will take, the more electricity it'll burn, and the harder it will be to mine. But once we hit 20 million, then the Bitcoin network is no longer supported by mining. It's going to have transaction fees, which I haven't seen how that's been worked out. I don't know that people are going to use it if you have to pay a transaction fee. I don't know. Time will tell. And yeah, mining is uh, basically going through the hash um, until you're correct. But uh, yeah, it continues until we're not 20, 2110, 2140. So maybe we got another 100 years um, until 21. I'm sorry, 21 million Bitcoin, not 20 million. So anyway, yeah, that Bitcoin mining. If you for the processing it takes to verify these transactions and commit them, um, results in bitcoins or partial bitcoins um, being issued. Um, and so, yeah, mining. Anyway, uh, Bitcoin mining, you've probably seen in the news, uses as much electricity as a small to medium sized country globally. And I just, and I don't think anything that's got that kind of overhead has legs. But um, some people are jumping on it. So what do I know? What do I know? And here's the total supply over time. You see um, the supply at first uh, increases, I don't know, more than exponentially. But if you look at like where we are now, 2020, see where that line, it's going to taper off, barring something like a quantum computer that'll chew right through it and burn the whole thing down. Um, it gets harder and harder and harder and harder and harder and harder and harder to mine new bitcoins, as you get more of them, and the chain gets longer. So there's ways to get bitcoins. You can burn electricity and be part of this mining network. There was a time in 2009, 2010 when that was absolutely something an individual person could get into, but now it's enormous banks of servers that are doing it. I mean, you can still buy a machine, but it's a race. It's a race to get to the Bitcoin when you're a miner. You can accept them as a means of payment, which is what your paper will be about um, this week. You can trade them. They're trade different cryptocurrencies, um, or for cash. You can earn them as a regular income, or interest payments, which is that's just a conventional financial instrument. So nothing new there. And then yeah, donating, gambling. Um, Someone can tip you in satoshis. I don't think anybody's going to get tipped an entire Bitcoin, but and then yeah, there's a whole underground economy based on Bitcoins. So there you have it. Okay. Um, so the price of Bitcoins was really constant, really fairly low till about 2013 or so, and then shot through the roof. This is only the first spike. This where it shot up to 1,000 in 2014. But let me stop sharing that for a second and go to the web. Because I think, yeah, I wanted to show this chart. Hopefully you can see this okay. You can certainly bring it up yourself if not. Yeah. Um, if we go to max, uh, that Google tracks anyways, back when it was a few $100 a Bitcoin, but for the 4 or 5 years before that, it was, you could buy a Bitcoin for $1 or three or five or so, and then we had this first spike, real identifiable spike in 2018, when it jumped up to yeah, 15, 16,000. There you go, 19,000. Um, December 17, and then crash back down to 3,000. So peaked at, what did we say, 20,000. So if the stock market did that, if the stock market dropped by 90% in value, um, there'd be trouble, right? But Bitcoin can do it because anyway. So yeah, and then peaks and valleys and peaks and valleys, peaks and valleys, and then whoa, 2021, bam, all the way up to 60,000 this spring, earlier this spring. But now it's back down to 32. So its value's been cut in half. It's so volatile. Anyway, so there's your value. But back to our chart. You can look at it against the price of gold, which is got peaks and valleys, but it's fairly straightforward. But as it came down, Bitcoin's going up. See that? And actually, if I did a little data analysis, if you would have gotten out of the stock market in the summer, early fall of 1999. I know some of you were little kids. But if you'd have gotten out of the internet bubble before it popped in the fall of '99, and put all of your money in gold, uh, gold was worth I don't know, a couple $100 an ounce. And then if you would have held on to that gold from way back here, yeah, see this chart, it's showing gold at like 300 an ounce on January 1st, 2000. Yeah. So if you'd have put all your internet bubble money into gold and then held on to it, it would have increased from um, 250 to $1,600 uh, per ounce. So in the span of 12 years, uh, you'd have not times 10, but what times 6 or 7 your money. But then if you'd got out of gold um, in 2012 and got into Bitcoin, oh my goodness, those three commodities, traditional stocks, gold, and then Bitcoin. If you'd have done it at the right time, you'd be worth a bunch of money. But anyway, the reason it did had something to do with the financial crisis of conventional investments. So Bitcoin became a way, an alternative to um, the commodity market or the stock market. Um, yeah, place to put your money while um, the conventional market stabilizes. So theoretical and technical problems, yeah. Illegal activity, it's because of the animosity or animosity, anonymity thing. It's all of these ransomware attacks are in Bitcoin or some cryptocurrency. All of them. No one is making a conventional banking transfer to pay criminals, which you would kind of almost think it makes it illegal, which people are looking at illegalizing it. But anyway, speculation. Goodness, that's what it is. It's speculative. It's look at the volatility. If it was real, the real world prices haven't changed in the real world anywhere near like Bitcoin has, and the very nature of the currency because nobody's in charge. It's worrisome. Uh, but there's there's the software works as far as we know. We've got regulation and taxation issues which are being tackled. It's starting to just be considered a commodity, um, or a security. Really, it's what it really is. I mean, it's like a share of stock in a company with no actual value. But if you buy it low and sell it high, there's capital gains. So that's the easy way to regulate it. It's just treat it like anything else. Um, there's uh, yeah, there's dispute of the status. What is it? What is it? Who owns it? It just makes governments nervous. Governments that are there to protect us against cyber criminals. Um, Governments that are there to draw a little bit of income off of the economy to pay for services. Of course, you got the mining problems, which to include the electric bill. Hello. Um, Theologies. Skepticism towards implementation of new unregulated theologies in finance sphere. Yeah, theologies are religions. So not really sure where that came from. I think that's supposed to be technology, maybe. Uh, okay. Illegal activities and speculation. Yeah. How can it be anonymous and transparent at the same time? You may say it is, but I will say that by my definition and the dictionary definition, you can't have both of those. So anyway, why would somebody give you $27,000 for solving impractical mathematical equations? That's, I guess, the at the time of the writing of these slides, a Bitcoin was worth $27,000. Um, and yeah, they're not being exchanged like cash. Cash flows through the economy. Bitcoins are being held onto. So that's not necessarily a good thing from an economic standpoint. Uh, Alrighty. And then how to regulate it. The Fed on the left here is the Federal Reserve. Um, and they've, in years gone by, and they can always reassess this stuff, but they've, it's not money. It's not money. It's a thing. It can be, it represents value to the people that own some of it. Doesn't I don't own Bitcoin. Doesn't matter to me if the whole thing crashed right now. But uh, and neither do any of my investments hold any cryptocurrencies. So I don't have a dog in the fight. It's not money. So the Fed doesn't want to supervise or regulate it, at least in years gone by. The Securities and Exchange Commission, which regulate the stock market, is it a security? And that's, like I said, as far as I can tell, that's where the wind is blowing, is treating it um, like a security, like a share of stock, or like here we're saying here, an investment contract where, if I buy this, you like a bond, a bearer bond or something, it represents value. So anyway, should it be the Treasury? Um, so yeah, if it remains impractical, I think the time it takes to do a transaction, and the amount of electricity, in and of itself makes it a ineffective technology, personally. So and then you've got this Commodity Futures Trading Commission, which uh, is very likely um, a possible regulatory agency in the future, because that's kind of really what we're talking about. So, um, yeah, three ways that a Bitcoin generates income. Um, uh, Pure market volatility, knowing when to buy low and sell high. Um, uh, SA payments, as payments, if they are received by merchants as payments for goods and services. Like, apparently you can buy a Tesla with Bitcoin. Uh, um, Elon Musk is like, sure, what the heck? I'll take a Bitcoin. I'll take Bitcoin in payment. Okay. Uh, so to me, the volatility is a good enough reason for a government, for a business to not accept it. Um, Generally speaking, companies operate on, an income flow where they get paid in currency, and they use that to invest, and they can project, you know, if I take this income, save some of it, reinvest it, I'll be able to use my business model to make a certain amount of money. But if what somebody is paying you in could lose value by 10 or 20%, a day, or in a matter of a week, how do you plan? So, you know, converting it instantly, taking Bitcoins, but converting it instantly to dollars, makes sense. But then what have you really done? What's the point? So anyway, there's that. And then, of course, mining problems. You've got, uh, um, using computing power of third parties. So yeah, if you were a nation state with the financial wherewithal of a China, Russia, India, Brazil, America, Canada, and it's just a matter of buying computing power. That, to me, that's dangerous. But the network's also vulnerable to a distributed denial of service attack, which is where you just basically flood the network with traffic, so that nobody can get any processing done. That's no different than what we've seen in the web for 20, 25 years. And these two, best as I can tell, the 51% and Goldfinger attack are the same thing. That's and again, I'm no cryptocurrency processing expert, but that's where if any single entity or group of entities working together had more than half of the processing power of the mining network, they could do things like double spending of the tokens before they could get caught, and it would bring the whole thing down. It would bring the whole network down if that were possible, and that's one of the disruptive issues of quantum computing that I've heard is, the first quantum computer will render um, well, it'll render a lot of current cryptography um, um, irrelevant, which is scary if you think about it. If absolutely every password, everything, every encrypted tunnel could be decrypted um, by the first quantum computer, and who knows what's going on in those laboratories? It might be going on right now. But anyway, yeah. So you got issues, and like I said, the electrical bill for Bitcoin is just it's staggering. It's ridiculous. And you know, I'm trying to figure out where all these computers are. Really, really, these data centers are really being used for this. So okay, all right. So your paper this week, um, all of my opinions notwithstanding, there, use the academic literature, of course. We'll stop that share and we will share the classroom. First, I have to pull up the classroom. Bam, there we go. Okay, so your paper this week. I think that's what I got. Yeah, there we go. Your paper this week, week 10 research paper. Okay, so yeah, a lot of papers on the web for this one. A lot of your former colleagues have posted their papers to the web. So I suggest you start from scratch, as I always do. So this week, you'll search the library and explain two major companies that have adopted Bitcoin technology, um, and one that has refused. Okay, two companies that are taking um, Bitcoin, not just blockchain, and find a case study of one that has refused. Now, a lot of this is going to be in practitioner literature, not necessarily, a stale academic journal article. So you can use Wired, Forbes, Harvard Business Review, Business Week, Fast Company, those sort of websites, um, in for a lot of this blockchain because it really hadn't been studied all that much. Okay, so I don't need a long overview of the company. You're going to be talking about major companies. So one sentence to basically talk about what the company is. Okay, one sentence. Um, so uh, how they adopted or why they won't adopt Bitcoin, and then your recommendations. What recommendations you have for them to continue to support, or why they should support Bitcoin if they're not. Okay. There you go. There is your challenge. Um, I'm sorry, I was distracted by the I don't put these plagiarism tip things in here. This comes from the. It's easy to commit plagiarism by mistake. It can happen to anyone. I disagree. Sometimes plagiarisms happen because we are writing so much on a topic and we want to make sure we get it all on paper. However, that can lead to accidents. Please view this presentation on how to avoid this trap and a way to gather your thoughts on paper and avoid plagiarism trap. I don't agree. Well, I mean, I do agree that if we were really, really, really serious about plagiarism, um, that it can be by accident. But what I'm seeing is blatant cutting and pasting. And using the structure of someone else's paper. It's not something that happens by accident. At least when I ask, no one has said, "Oh, that was completely a coincidence. That was absolutely accidental." It's cutting and pasting. It's just too easy to do. And then there's the article spinning, which I know some of you are dismayed at my opinion of, but it's the same thing. So anyway, yeah. Um, Two companies that are accepting it, one that is not. And I look forward to seeing your work at the end of week 10.